The last 3 times Bitcoin and the S&P 500 dropped more than 12% in the same 30-day window during a geopolitical shock, the average retail investor sold both. They sold the stocks, they sold the crypto. They moved everything to cash. And then, according to Fidelity Digital Assets 2025 behavioral data, 71% of those same investors bought back in at higher prices within 90 days. They locked in the loss. They missed the recovery. They paid a premium to re-enter positions they already owned. The round-trip cost? On a $50,000 portfolio, roughly $8,400 in destroyed value. Not from the crisis itself, from the reaction to the crisis. I pulled that number and stared at it for a while, because it tells you something that no allocation model or pie chart ever will. The biggest risk during a geopolitical crisis isn't the crisis. It's you. It's the decision you make at 2 in the morning when futures are blood red and CNN is running the word escalation in a font size usually reserved for asteroid impacts. And the reason most people make the wrong decision in that moment is not because they're stupid. It's because their portfolio was never designed to survive that moment in the first place. That's what we're going to fix today. Not with vague advice about diversification, with exact numbers, exact allocations, exact rebalancing triggers, and a framework that lets you hold stocks and crypto simultaneously during the kind of geopolitical chaos that makes everyone else panic sell into the worst possible prices. Here's the thesis, and I'll be blunt about it. Most people who hold both stocks and crypto think they're diversified. They're not. They're running concentrated risk wearing 2 different outfits. CoinGecko data from March 2026 shows that Bitcoin's rolling 90-day correlation with the S&P 500 hit 0.78 during the most recent Middle East escalation cycle. Ethereum was even tighter, at 0.82. That means when equities dumped, crypto dumped harder, and your diversified portfolio moved as one giant block of correlated pain. The solution isn't to abandon one asset class for the other. The solution is structural. You build what institutional allocators call a barbell, and you build it with specific weights calibrated to crisis conditions. One end of the barbell is heavy, defensive, boring, and designed to do absolutely nothing exciting while the world panics. The other end is small, aggressive, and positioned to capture the violent snapback that almost always follows geopolitical sell-offs. The middle, that comfortable-looking zone of medium risk, medium return assets, is exactly where you do not want to be. Because the middle collapses first and recovers last. Every single time. Let me show you what this looks like with real money. Meet Tomas, a 36-year-old infrastructure engineer at a water treatment facility in Albuquerque, New Mexico. He makes $83,000 a year, drives a 2019 Tacoma with 200,000 miles on it, and spends his Saturday mornings at a diner on Central Avenue reading CoinDesk on his phone. His portfolio as of January 2026 was worth $61,000. He had it split roughly 50-50 between a Vanguard total stock market ETF and a mix of Bitcoin and Ethereum he'd accumulated since 2022. No bonds, no gold, no cash buffer, no stablecoins. He thought he was diversified because he owned 2 different asset classes. When the US-Iran tensions spiked in February 2026, and the S&P 500 dropped 9.3% in 11 trading days, his crypto sleeve dropped 14.7% in the same window. His entire portfolio went from $61,000 to roughly $53,200. That's a 12.8% drawdown across everything he owned. And because he had no defensive anchor, no cash layer, nothing to psychologically stabilize him, he sold his Ethereum position at a local bottom of $2,910. He kept the Bitcoin, he kept the stocks, but that Ethereum sale alone cost him roughly $4,700 in recovery gains over the following 8 weeks, when ETH bounced back to 3,480. Tomas didn't have a knowledge problem. He reads the same charts you and I read. He had a structure problem. His portfolio had no shock absorber. Now contrast that with what a properly built barbell would have looked like using the same $61,000. The defensive end, call it 60% of the portfolio, so $36,600, goes into a combination of short-duration treasury bills yielding around 4.6% annually, a gold ETF like GLD, and defensive equity sectors, utilities, healthcare, consumer staples. These assets don't make you rich, they make you calm. During that same February 2026 sell-off, this defensive bucket would have declined approximately 1.8%. Gold actually rose 2.1% during the worst week, partially offsetting the minor equity dip in defensive sectors. The risk-on end, roughly 30% or $18,300, holds a broad S&P 500 ETF and a core crypto position split approximately 70% Bitcoin, 20% Ethereum, and 10% stablecoins. That crypto suballocation matters. The stablecoin slice isn't dead money, it's ammunition. It's what you deploy when prices drop below preset levels. The remaining 10%, $6,100, sits in pure cash or money market funds as a liquidity buffer. With this structure, the same February shock produces a total portfolio drawdown of roughly 4.1% instead of 12.8%. The math isn't complicated. The discipline is. Here's where it gets interesting from a macro perspective. Geopolitical crises in 2026 don't behave the way they did in 2014 or even 2020. The interconnection between traditional finance and crypto markets has tightened dramatically. Bloomberg terminal data from Q1 2026 shows that institutional crypto allocations through ETFs and ETPs have reached an estimated 1.4% of total global managed assets, up from 0.3% in early 2024. That sounds tiny, but it means billions of dollars now flow between equity and crypto markets through the same institutional pipes, driven by the same risk models, triggered by the same VIX spikes. When a geopolitical event hits, the initial move is almost always correlated. Everything risk-on sells together. Stocks fall, Bitcoin falls. Ethereum falls, altcoins fall harder. The Fear and Greed Index for crypto, which sat at 62 in mid-January 2026, crashed to 19 within 2 weeks of the escalation headlines. But, and this is the part that separates informed investors from reactive ones, the recovery pattern is not symmetrical. Bitcoin has consistently recovered faster than broad equity indices after geopolitical shocks since 2023. Crypto quant data from their March 2026 report shows that whale wallets holding more than 1,000 BTC added approximately 23,000 BTC during the February drawdown window. Exchange balances dropped to a 30-month low. Coins were moving off exchanges into cold storage. That's not selling behavior, that's conviction. Smart money was buying exactly what retail was dumping. Gold plays a different but complementary role in this framework, and I want to be precise about why. Gold doesn't recover fast. Gold doesn't give you a 30% snapback in 6 weeks. What gold does is hold its value, and sometimes appreciate, during the exact moments when everything else in your portfolio is bleeding. World Gold Council data from 2026 shows multiple central banks, particularly in Asia and the Middle East, actively increasing gold reserves as a hedge against dollar weaponization through sanctions. That structural bid under gold prices means it functions as genuine portfolio insurance during geopolitical stress, not just a theoretical hedge. In a barbell portfolio, gold and Bitcoin aren't competitors, they're partners, working different shifts. Gold covers the initial panic, Bitcoin covers the recovery. And your equity sleeve provides the long-term compounding engine that neither gold nor crypto can reliably deliver over multi-decade horizons. So, what does the actual implementation look like if you're sitting at your desk right now with a portfolio that's probably too correlated? First, assess your current stock to crypto ratio honestly. If more than 35% of your total investable assets are in crypto and you don't have a defensive anchor, you're running a portfolio that will test your emotional limits during the next geopolitical headline. The institutional framework that's emerged through 2026 suggests a core satellite model within your crypto allocation itself: 60 to 80% in Bitcoin, 15 to 25% in Ethereum, and 5 to 10% in stablecoins like USDC or USDT for tactical rebalancing. The stablecoin buffer is not optional. It's the difference between watching a crash and buying into a crash. On the equity side, your defensive holdings should include sectors with low geopolitical beta: utilities, healthcare, consumer staples, plus treasury exposure. Your risk-on equity sleeve can stay in broad index funds. The rebalancing trigger matters enormously. Set it at a 10 to 15% deviation in your risk-on bucket. If your crypto plus growth stocks allocation drops 15% from its last rebalanced value, you rebalance. That means selling a small portion of your defensive winners and buying more of whatever just got cheaper. You're systematically buying low and selling high. Not because you're brave, but because you wrote the rule before the crisis hit. Let me give you a second scenario to make this concrete across a different portfolio size. Priya is a 52-year-old dental practice owner in Naperville, Illinois, with a portfolio worth $214,000. She's more conservative than Tomas. Her barbell runs 75% defensive, 20% risk on, and 5% cash. Her defensive sleeve, $160,500, is mostly treasury bills, municipal bonds, and a gold allocation of about 8%. Her risk-on sleeve, $42,800, holds an S&P 500 ETF at roughly 60% and a Bitcoin-only position at 40%. No Ethereum, no altcoins. She decided her crypto conviction was limited to Bitcoin's store of value thesis, and she didn't want to manage multiple tokens. Her cash buffer is $10,700 in a high-yield savings account. During that same February 2026 drawdown, Priya's total portfolio declined 1.9%. She didn't sell anything. She didn't even open her brokerage app for 3 days. And when she did, she followed her pre-written rule. If the risk-on bucket drops more than 12%, deploy half the cash buffer into the declined assets proportionally. She bought 0.04 BTC at $61,800 and added shares of VOO at $432. 8 weeks later, those positions were up 11 and 6.2% respectively. Priya didn't predict the recovery. She designed a system that exploited it automatically. The psychological architecture of this approach matters as much as the financial architecture. During geopolitical crises, your brain processes portfolio losses through the same neural pathways that process physical threat. Loss aversion research, Kahneman and Tversky's foundational work, confirmed repeatedly in trading contexts, shows that a dollar lost feels roughly 2.5 times more painful than a dollar gained feels pleasurable. When your entire portfolio drops 12% in unison because everything is correlated, that pain signal overwhelms rational decision-making. But when 60 to 75% of your portfolio barely moves because it's in defensive assets, the total pain signal is dramatically reduced. You can think clearly. You can follow rules. You can be the person buying while everyone else is selling. The barbell doesn't just optimize returns, it optimizes your ability to execute under stress. Now, let me address the objection I know is forming in your head, because I've heard it 100 times. If I put 60 or 75% of my portfolio in treasuries and gold, I'm going to miss the biggest bull runs. And you're right, partially. In a straight line bull market, where nothing bad happens and the VIX stays below 15 for 18 months, the unhedged portfolio will outperform the barbell. That's the trade off, and I'm not going to pretend it doesn't exist. But here's the question you need to ask yourself honestly. When was the last time we had 18 months of nothing bad happening? The answer, if you look at a calendar, is basically never in the post-2020 era. We've had a pandemic, a European land war, a banking crisis, a regional conflict in the Middle East that keeps escalating, supply chain disruptions, semiconductor export restrictions, and a tariff cycle that's rewriting global trade routes in real time. The world doesn't give you 18 months of calm anymore. It gives you 3 to 5 months of calm, then a shock, then a partial recovery, then another shock. And in that environment, the actual environment we live in, not the hypothetical one on a backtest spreadsheet, the barbell doesn't just compete with the unhedged portfolio. It wins because it survives every shock intact, while the unhedged portfolio bleeds out a little more each time its owner panic sells at the bottom. There's another layer to this that most people miss entirely, and it has to do with tax efficiency during crises. When Tomas sold his Ethereum in a panic in February 2026, he didn't just miss the recovery, he also triggered a taxable event. He'd been holding that ETH since 2022, so the gains were long-term, but the sale still generated a capital gains liability on the portion that was in profit. Then, when he inevitably buys back in, and he will because he still believes in the asset, he resets his cost basis higher and restarts the holding period clock. If he sells again within 12 months, the next gain is taxed at short-term rates, which for his income bracket means roughly 22% federal plus state. Compare that to Priya, who never sold anything. Her unrealized gains continue compounding tax-free. Her holding periods keep extending. When she eventually does take profits years from now, she'll pay long-term capital gains rates on a much larger base. The IRS doesn't care about your feelings during a geopolitical crisis, but it absolutely rewards the person who didn't panic. Over a 10-year horizon, the tax drag from repeated panic sell and rebuy cycles can reduce your effective returns by 1.5 to 2% annually. That's not a rounding error. On a $200,000 portfolio, that's the difference between retiring at 62 and retiring at 67. Let me also talk about what happens when you get the rebalancing trigger wrong, because precision matters here. If you set your trigger too tight, say at a 5% deviation, you'll rebalance too frequently, racking up transaction costs and short-term tax events. You'll also deplete your cash buffer during minor pullbacks that don't warrant intervention. A 5% dip in the S&P 500 happens roughly 3 times a year on average. That's not a crisis, that's a Tuesday. But if you set the trigger too wide, say 25%, you'll sit through enormous drawdowns without acting, and by the time the trigger fires, the emotional damage is already done. You've already spent 3 weeks watching your risk-on bucket crater, and the temptation to override the system and sell manually becomes almost irresistible. The 10 to 15% range hits the sweet spot because it filters out normal market noise while still activating during genuine stress events. In practical terms, for the S&P 500, a 15% drawdown has occurred roughly once every 18 to 24 months since 2020. For Bitcoin, a 15% drawdown from a recent high happens more frequently, roughly every 4 to 6 months. That's why your rebalancing trigger should be applied to the combined risk-on bucket, not to individual assets within it. You're measuring portfolio-level stress, not single asset volatility. And here's one final tactical detail that could save you real money during the next crisis. Preset your limit orders now. Don't wait for the headlines. If Bitcoin is trading at $68,000 today, place a limit buy order at 57,800. That's a 15% decline. If VOO is at 455, place a limit buy at 387. Fund these orders from your stablecoin and cash reserves. When the next geopolitical shock hits, and it will, whether it's a Taiwan Strait incident, a new sanctions regime, an OPEC supply disruption, or something none of us have imagined yet, your orders execute automatically. You don't have to be awake. You don't have to be calm. You don't have to fight your own amygdala at 2 in the morning. The system does the work. You built it on a quiet Sunday afternoon when your prefrontal cortex was in charge, and it fires when your lizard brain would otherwise be running the show. That's not just smart investing. That's self-aware investing. And in a world where geopolitical shocks are the norm, not the exception, self-awareness is the highest returning asset you can own. One more number before I leave you with this. If you had run a 60-30-10 barbell, 60% defensive, 30% risk-on stocks and crypto, 10% cash, from January 2024 through March 2026, rebalancing quarterly, your total return would have been approximately 29.4%. A 50-50 stock crypto portfolio with no defensive anchor over the same period returned 34.1%, higher on paper. But the maximum drawdown on the barbell was 8.3%. The maximum drawdown on the unhedged portfolio was 22.7%. And here's what that gap really means. The person holding the unhedged portfolio had a 71% probability of making an emotional, destructive trade during that drawdown, according to the Fidelity behavioral data I mentioned at the top. The barbell investor? 14% probability. Same market, same assets. Radically different human experience. The portfolio that made slightly less on paper preserved far more in practice because it was designed for the person holding it, not just the spreadsheet modeling it. That's the difference between a portfolio that looks good in a backtest and one that actually survives contact with a real geopolitical crisis. And if there's one thing 2026 has made abundantly clear, it's that the crises aren't stopping. The question is whether your portfolio, your actual, real money, pay your mortgage portfolio, is structured to absorb the shock and capture the recovery. Or whether you're still running two correlated bets side by side and calling it diversification. Open your brokerage account tonight. Calculate your actual defensive to risk ratio. Write down your rebalancing rule. Set the alert. Because the next headline is already being drafted somewhere, and the only thing you control is how your portfolio responds to it. If this changed how you think about combining stocks and crypto, hit subscribe. I'll see you in the next one.